So interest means when money is lent, yes, the borrower usually pays a fee to the lender. That fee is called as interest. Yes, when you are borrowing some amount and you're paying any amount to your giver, yes, that lender. So that is what interest, that fee we are paying for using that amount. That is interest. So that interest can be simple or compound interest. Yes, that interest can be what? Simple or compound interest. Yes, we can see there are two types of interest. Simple interest, compound interest. Yes. Now, what is simple interest? Simple interest means here amount of interest calculated as a fixed percentage of the amount borrowed or lent at the start and is paid on receipt end of the contracted period. So basically whatever amount you have borrowed, every time you are paying fixed percentage on that fixed amount only. Yes, like in suppose if I am depositing 1 lakh rupees and every year bank said that we will pay that interest 6% on 1 lakh rupees. So that means every year on this principal amount I am receiving, so that is simple interest. Yes, so what formula I am going to use here? Interest equal to principal into R into T. PRT. Yes, interest equal to P into R into T. Principal amount, that is our base amount, what we are borrowing as a loan, what we are depositing, yes, that is your principal. Rate means whatever the return we are receiving, yes, whatever the rate we are paying on that loan or we are receiving because we are depositing, correct? And the last is your time. For what time period we are depositing or for what time period we are taking this loan. So that is your T. P into R into T. This will give you interest amount. Yes, this will give you interest amount. Okay. So let's solve one question based on this. Find the simple interest on 5,000 at 8% per annum for 2 years. Now here we need to calculate simple interest. P into R into T. Principal amount is your 5,000 into 8% and 8% is your per annum, correct? 8% is your per annum. But here in question they are asking for 2 years. So what is the time period? That is 2 years. So multiply this and tell me the answer. 5,000 into 8% into 2. Yes. So what is your answer? Your answer is 800. Correct answer is 800. If you multiply with just 1, like 5,000 into 8% only if you are doing, then that is 400. For first year, you are receiving 400. Yes, but here in question they are asking about second year. That's why your correct answer here is not 400. Answer is your B. This is how we need to calculate simple interest. Now, coming to the same simple interest formula. So, simple interest questions can be solved by applying the following formulas also. Just now you have seen that simple interest equal to P into R into T. Yes, you can write this as P into R and T. Same thing. Yes, we are just removing the sign. We are just writing both the R and T together. That means also multiplying. Yes. So you can write like this also. Or for accumulated amount. Yes. If someone is asking like after 2 years. Yes. After 2 years, what is the total amount? What is the total amount? Like in our previous question, if someone asks you, what is the total amount? Yes. So what you will do? You will add 5,000 plus 800. So this is your 5,800. Means principal plus interest. This is your 5,800. Yes. And this 5,800 is your A amount. Accumulated amount. A amount. This is the final value of a deposit at the end of the period. Yes, that is a total amount, correct? Then P is your principal amount, initial amount of the deposit. R is your annual interest rate, that is expressed as a decimal fraction, and I is your interest after T years. What is the interest you are going to charge or you are going to receive? Yes. Now, when we are talking about this R now, so R means 8%. Yes. Now, if you want to write in decimal, you can write it as 0.08. Yes. Now, if you want in fraction, 8 divided by 100. These are the different patterns which you can use for calculating the rate. Yes, 8% can be written as 0.08 if they are asking as a decimal, or they can write in fraction also, 8 divided by 100. Everything is same only. Yes. So this is about the formula which is related to a simple interest. And remember this formula. Yes, A equal to P into I equal to P into R into T. This is very important when you are upgrading this concept. Yes, when you are seeing the difficult concepts, that time we are using this formulas. Chali. Let's solve one more question based on this. Mohan invested 5,000 in a company's fixed deposit with an interest rate of 9.8%. How much interest would he earn in 3 years? Now again we need to calculate. Here that simple interest, P into R into T. Yes. So here we are saying that every year that Mohan will receive same interest rate, that is 9.8%. So here 5,000 equal to, okay. Here we are solving this question that every year you are going to charge that rate on this principal amount only. Okay, here we are not doing any compounding. We are saying that every year on this 5,000 only we are charging. So 9.8% into 3 years. So what is your simple interest? 5,000 into 9.8% into 3. So correct answer is 1470. This is your simple interest. This is your interest answer. If in question they're asking you about the accumulated amount, yes, or total amount, accumulated or total amount, then P plus I. P means 5,000, I means 1470. So what is your accumulated amount? Plus 5,000, 1470. So this is your 6470. This is your accumulated answer and this is your interest answer. Yes, so how much interest would he earn? That is 1470. This is how we need to calculate simple interest. Yes. Now, coming to one more question. All these questions are from your IFBF book. Yes, that study material that is provided by IFBF. So we are solving from that book only. Let's solve the next question. A student purchases a computer by obtaining a loan on simple interest. Yes, already in this question they have provided you that this student obtained the loan on simple interest. The computer costs 60,000 and the interest rate on the loan is 12% per annum. If the loan is to be paid back after 2 years, so here we need to calculate two things. Okay, first the amount of total interest to be paid. Second, the total amount to be paid back after 2 years. First, let's calculate. First part, that is amount of total interest to be paid. We need to calculate means interest. P into R into T. Principal amount, that is your 60,000. Rate is 12% and time period after 2 years. What is your interest amount? 60,000 into 12% into 2. So your interest amount is 14,400 interest. Now, second part, the total amount to be paid after paid back after 2 years means we need to calculate accumulated amount. So how to calculate accumulated amount? That is your P plus I, principal plus interest. Principal amount is your 60,000 plus interest amount is your 1440. So this is your 7440. This is your answer. This is your answer. Okay. So this is how we need to solve your simple interest in case they are asking about total amount like accumulated amount, or if they are asking interest calculation. This is how we need to calculate. All these questions, this one, previous one and this one, all three questions are from your IFBF book. Okay, so the chances are there that they can ask the direct question based on this. Now, coming to the next part, that is your compound interest. Okay, compound interest means interest here we are receiving. Whatever interest we are receiving, we are reinvesting it. Okay, so the total amount that we are getting, okay, whatever interest we are receiving, we are not withdrawing, we are reinvesting. So what is the total amount we are generating? That is what compound interest is talking about. So compound interest means if the interest is charged more than once during the period and the interest is reinvested, we need to compound the interest. Okay? Suppose today I am investing rupees 100. After 1 year, I am getting along with interest this amount as 110. Okay? So on this, I suppose I charge 10%. Now again I am investing this 1110 for 1 more year at the rate of 10%. So at this point of time, I am not going to calculate 10% on this 100. I am going to calculate 10% on 110. So 110 into 10%, that is going to be your 11. Yes, that is going to be 11. So 110 into 10%, that is your 11. Means after second year, I am going to receive 121. This is the total amount. This is the total amount. This is not your simple interest that every year you are going to calculate on this principal amount. Every year on total amount we are calculating. Okay, whatever interest we are generating, we are reinvesting it, and again on that we are calculating the interest amount. This is what compounding is all about. Okay, so what formula we need to use here? A equal to P into 1 plus R divided by N whole to the power N into T. A means here the amount accumulated. Yes, after 2 years, what is your total amount? That is what accumulated. P means your principal amount. R is your rate of interest. Yes, like 6%, so 0.06, 6 by 100. That is your R. Number N means number of times per year the interest is compounded. If in a 1 year only you are getting quarterly returns, at that time we are using this N. When we are going to use N when in a single year, like you are receiving quarterly return, yes, half yearly, weekly. If this type of return you are receiving, then at that time you are going to use N. Otherwise, no need to use N if you are calculating for per annum. Yes. Now, T number of years for which the principal amount is invested. So this is the formula which we are going to use for calculating compound interest. A equal to P into 1 plus R to the power T. Yes, if you are ignoring N, A equal to P 1 plus R to the power T. Okay, if you are not receiving any quarterly, half yearly or weekly returns, at that time you can use this formula. A equal to P into 1 plus R to the power T. Chaliye. So let's solve one question based on this. Find the compound interest on 5,000 for 2 years at 10% per annum compounded annually. Means yearly interest we are receiving. Okay, no half yearly, no quarterly, yearly we are receiving. So let's solve this question. A equal to P into 1 plus R to the power N. Sorry, this is your T. This is your T. ठीक है? So P is your 5,000. 1 plus R is your rate of interest, that is 10%. I already informed you 10% you can write as 0.10 or 10 divided by 100. Okay? And time period is your 2 years. 2 years. Now how to solve this part? Let me explain you with the calculator. See, whatever in bracket they are given. So here they are giving 1.1 to the power 2. Hana, if you add this two things, 1 plus 0.10 power 2, means we need to calculate here square. Yes, we need to multiply this 1.1 2 times. 1.10 into 1.10 we need to do. For calculating square, we need to multiply the same thing for 2 times. Yes, suppose if I want to know what is the square of this 2, I will do what? 2 into 2 means 4. Hana? If I want to know the square of this 3, I will multiply 3 into 3, 9. Okay? If I want to know 4 square, means 4 into 4, that is 16. That is what square means, Hana, when we are multiplying the same number 2 times. Yes? But how to calculate when decimals are given? So, with the help of this calculator, you can calculate it. Just type the base amount. 1.10 is your base amount. Type this on your calculator. 1.10, then multiply, press multiply button and just press 1 time equal to. Just press 1 time equal to, and on your screen you can see this amount is 1.21. Yes, or if you multiply this 1.1 into 1.1, you can see the same amount you are receiving, 1.21. Okay, this is how we can calculate the square root. Okay, once again I am telling you how to do this. I hope you are using your calculator for the calculation purpose. Hana, please use this calculator. Then only you can understand. Just by watching this session, you won't understand what we are doing. Just use this calculator along with me. Suppose here you have 1.15 to the power 2. So how to calculate with the calculator? Type this base figure, that is 1.15. Okay? 2 times when you calculate. When we want to calculate square, just multiply once and press equal to once. Again I am explaining. Type 1.15, press 1 time equal to and press 1 time multiply and 1 time equal to. So this is 1.3225. If I want to calculate 1.15 to the power 3, yes, if I want to calculate cube, type 1.15, press 1 time equal to button and this time press multiply button for the 1 time and press equal to button for 2 times, 1, 2. Yes, so your cube is going to be 1.5208. So what steps you can write over here? A, type base number. Okay. Then B, press multiply once, and C, press equal to button by 1 minus 1 time, n minus 1 times. N means, suppose here your power, n is your power minus 1. Okay? So if power is 2, press equal to button by 1 time. If your power is 3 minus 1, press your equal to button for 2 times. If your power is 4, press your equal to button for 3 times. Okay? So this 3 steps we need to apply on this calculator. So let's solve this question now. 5,000 into 1.21. So what is the final answer? 5,000 into 1.21. 5,000 into 1.21. So here your answer is 6050. This is how we need to calculate compound interest. Again, let's solve one more question. Find the compound interest on 10,000 at 8% per annum for 3 years. So this is your total accumulated amount. This is your accumulated amount. If I want to know about the interest, I can subtract A minus P, means 6050 minus 5000. So interest amount is 1050. Okay. Now let's calculate interest again. A equal to P into 1 plus R to the power T. P equal to 10,000. 1.08 to the power 3. Yes, means we need to multiply 1.08 into 1.08 into 1.08. This is what cube means. But for calculating with your calculator, first, what step we need to do? Type base number, that is 1.08. Yes, then B, press multiply button once. Yes, then press equal to button for n minus 1. N means your power minus 1 times. So here, for how many times we need to press equal to button? 3 minus 1 means for 2 times. Okay, chaliye. So these are the steps we need to follow. Please type 1.08, your base number, then multiply button once, equal to button for 2 times. 1, 2. What is the answer on your screen? 1.2597. Yes. So 10,000 multiplied by 1.2597. If you multiply with 10,000, this is your 12597.12. This is your accumulated amount. For interest, subtract this accumulated with principal amount. 12597.12 minus 10,000 if you will do, your answer is 2597.12. This is your final answer. This is a final answer. Okay. This is how we need to solve compound interest. Now, one more small topic we have that is very important again from the exam point of view, that is rule of 72. Rule of 72 means in how many years you can double your amount. Okay. If today I am investing 5,000 rupees, so in how many years I can get 10,000? What is the double of 5,000? 10,000 now. So in how many years I can get 10,000? For that I can use this rule, that is rule of 72. Rule of 72 you can use for knowing approximate number of years before your money doubles with yearly compounding. So this formula is 72 divided by R. This is the formula we need to use. Basic, very simple. 72 divided by R. Chaliye. So you have borrowed 1,000 at an annual interest rate of 6%. Using the rule of 72, calculate approximate how many years the borrowed amount will double if no repayment is made today. So can you tell me? 72 divided by R, that is a 6%. So in how many years? 72 divided by 6 means in 12 years your amount will double. Okay, your amount will double if you are not paying any amount today. Means after 12 years, this 1,000 will become 2,000. This is your rule 72. Okay, and remember, this is your interest part. But in this unit, we have annuities part also. For that, you can join my crash course, not crash course. You can join my upcoming batch, that is officers batch. Okay, whenever we talk about any organization, or chaliye, let's take one example. Suppose I want to start one business known as Aarti Private Limited. Okay, this is the business which I want to start. Now, if I want to start this business, I require funds. Yes, without funds, can I start this business? No. For purchasing, yes, for appointing laborers, for purchasing raw materials, I require funds. Yes, I require money. Now, What are the ways through which I can arrange this money? I can use my own saving. Yes, I can use my own saving. Yes, I can use my FD account. I can use my salary. Yes or no? And what is the one more way through which I can arrange these funds? That is through borrowing. Yes or no? That is through borrowing. I can borrow from my friends. Yes, from my family, from bank, etc. Yes, so there are two ways through which I can arrange funds. So this own savings, when I'm investing my own amount, that is your equity. Because as an owner, when I'm sharing the ownership, yes, when I'm sharing the ownership, when I'm having the ownership, or if I say, so I'm going to say whatever amount I'm bringing, that is equity. But on the other hand, when I'm arranging the funds from family, friends, bank loan, yes, that is borrowing. That is borrowing. And this debt means you're borrowing only. Debt means borrowing only. So debt means a sum of money due by one party to another. When I'm borrowing from bank, I need to repay. Hana, I'm going to repay interest. I'm going to repay that principal amount as well. So that is debt. Means here it creates the liability. Yes, that is what debt. Now, what are the sources you can see here? What are the different sources? Now, this sources is about funds. The source is about funds. So I can take FD. Yes, I can take amount from FD, or sometimes I can take loan against this FD also. Yes or no? This is one way. I can use bonds. Yes, as a company, I can issue some bonds to the public. Means I can raise amount through the public also. Then bank borrowing, like from SBI bank loan I'm taking, or other instruments like debentures. Okay? So these are the few ways through which I can arrange funds. Yes. Now, next important thing under this is your bonds and debentures, because mainly in this unit we are going to talk about the borrowing side. When we are using bonds, when we are using debentures, that bond side means that borrowing side we are talking about. So bond means and debenture means what? So bond means bonds issued by the government or by the public sector companies in India. Lower risk, more stable. Bonds, who is going to issue this? Public sector companies, again, which is backed by government or government companies. Yes, government can issue the bonds, public sector companies can issue the bonds in India. So that is going to have lower risk and more stability. See, if anything is related to government, government will never give any higher risk. Yes, because government is not here to earn any profit. Yes, they are here to give the benefit for the society. Yes, so their objective is not to earn profit. That's why whatever bonds government are issuing, that is having lower risk. And if any instrument is having lower risk, that is going to give lower return also. Always remember this point. Lower risk, when risk is low, yes, you will get lower return. Yes, because if you are not taking any risk, you will receive minimum return as well. Yes, like if you use fixed deposit, there is no risk. So that's why there is a very less minimum return. Yes, but if you invest in your share market, higher risk, higher returns. Correct? So next is your debentures. The private sector companies also issue bonds. But when private sector companies are issuing the instrument through which they are borrowing, that is known as debentures. That is known as debentures. Higher risk, more volatile. Higher risk, more volatile. Okay? If you invest in this Bombay Stock Exchange, National Stock Exchange, yes, if you're purchasing through this stock exchanges, Reliance Industry shares, Tata shares, share market, you must have heard. Then what we are purchasing through that market? Debentures. And debentures are issued by private sectors. Okay, and this gives the higher risk, and because of higher risk, as it is having higher risk, it will give higher or lower return? Higher return. No one can predict market. No one. Yes. So this is the difference between bonds and debentures. Okay. Both the ways, what common thing we are doing in both the side, we are borrowing. Okay. Chali. Coming to the next, that is bonds. Bonds. So a bond is a long-term instrument. Now long-term instrument means bond is going to have more than 12 months life, or security that pays a series of future cash flows consisting of interest payments over a period and redemption amount on maturity. Suppose what they are saying, let's understand with one example. Okay. Suppose if I want to take SBI bank loan, and this loan is for that home loan. I have applied for home loan. Okay. Suppose I applied for 50 lakh home loan. Now tell me, what things I need to pay to this SBI bank? Interest. Yes or no? Interest as well as principal amount. Yes or no? Interest as well as principal amount. Correct? So when I am repaying it, because I have liability to repay principal amount, and for using the principal amount I am paying extra fee, that is interest. The same thing under bonds we are doing. As a company, this is Aarti Private Limited. Now Aarti Private Limited wants fund. Yes, now Aarti Private Limited wants fund. So what they can do, they can issue bonds. They can issue bonds. This is one instrument, and this instrument is issued, or let's say this is not private company, this is your limited. Yes, this is your PSU, Aarti Limited. So here we are issuing the bonds to public. Okay. So while issuing the bonds, this is the instrument we are transferring to the public, and from the public we are raising amount. Okay, we are raising amount from public. Now in this case, Aarti Limited, this is the first thing. Company is issuing bonds to the public, and public will pay or give amount to Aarti Limited. Okay, this is the first thing. Second thing, Aarti Private Limited, Aarti Limited company will pay timely interest on this bonds, because Aarti Limited will use amount which is raised, which they have raised from public. Okay, so for that they will pay interest, and at the maturity, like we have raised this amount for 5 years. So at the time of maturity, Aarti Limited will repay the principal amount as well. Okay, so this is what they are saying. As an individual, when we are taking any loan, we are repaying the interest and the principal amount at maturity. The same thing companies are doing. They are taking loan from bank, no, from public. That time they are issuing bonds. Okay, they are giving an instrument, one certificate that yes, we are borrowing. That is a proof, because this bonds will act as proof that we have raised from public. Okay, so this is your bonds. For example, a company issued a bond, face value 1000, carrying a coupon rate 10% for 10 years. Here, what is the value of one bond? Here the value of one bond. One bond, that is rupees 100. Okay, and coupon rate, that is interest that we are paying, is equal to 10% for 10 years. That is 10%. What is the interest payment we are going to make on this bond? That is 10%. Okay, coupon rate. See that when we are taking loan from bank and we are paying some interest rate now, that is the same thing we are paying here also, known as coupon rate. Okay. Now, interest is usually payable at fixed intervals, like semi-annual, annual, sometimes monthly. Semi-annual means your half yearly. Then annual for 12 months. Yes, sometimes monthly For each month you are paying interest. So these are the way, some introduction of your bonds. First we have understood the meaning, then example, and then how interest here means your coupon rate, or you can say your coupon interest. Coupon means your interest only. So how you're doing your coupon payment. Okay. So this is about your bonds. Now, there are different types of bond. So let's start with the first one. That is fixed rate bonds. Fixed rate bonds. Like we have fixed deposit, FD. Okay. If bank is saying FD rate is 6%, means whatever amount individuals are investing, they will receive only 6% per annum. There is no change in this rate. Things are going to be fixed. Correct? Same thing we are going to apply in this bonds. If company that Aarti Limited is saying we are issuing bonds at the rate 12% per annum, that bond will hold 12% per annum till the life of that bond. Okay, suppose we have issued the bonds for life equal to 3 years. So for 3 years, each year 12% Aarti Limited will pay to their bondholders. Okay, now next is your floating rate notes. Floating rate, fluctuating. Yes, this is a variable coupon which is linked to reference rate of interest. If RBI is reducing their rate, they're increasing their rate. As per that, you can see the adjustment in the rates also. Okay, the rate is not going to be constant. Here you can see fluctuating. That is your floating rate notes. Next, zero coupon bonds. Now this is very interesting one, and this is important also. In exam they can ask you direct question based on this. So zero coupon bonds. Now zero coupon. See what I told you about coupon means? Coupon means interest. Now read it again. With this term, zero interest bond. Zero coupon bonds means zero interest bond. Zero means nothing. Hana? So here the bonds will carry zero interest. So as a bond holder, how we are going to earn? See, let me tell you. Here is Aarti Limited. Yes, here is our bond holders who are ready to purchase bonds. But this time, Aarti Limited said that we are issuing zero coupon bonds. Zero coupon bonds. And if you talk about the actual value of the bonds, yes, if you talk about the face value of the bond, that every time this Aarti Limited was issuing, that is equal to rupees 100. Every time Aarti Limited used to issue rupees 100 face value per bond. Okay, for 3 years at the rate 12% per annum. Okay. So this was the thing earlier they used to issue. But this time they are saying we are issuing zero coupon bonds. We are issuing zero coupon bonds. Now what is the zero coupon bonds? Means they are issuing the same bond which they used to issue at 100, and then on that bonds they were paying 12% for 3 years. Correct? But this time they are saying we are again issuing the bonds, but this time we are issuing the same face value which is 100, but we are issuing at 80 rupees for same life, that is 3 years. We are issuing for 3 years only, but this time we are issuing at discount. See the actual MRP, if you are not getting this thing, that biscuit packet is available for 10 rupees. Every time you pay 10 rupees for purchasing that biscuit packet. But this time that shopkeeper is saying you can purchase that same biscuit packet for 7 rupees. Means here you receive discount. Hana, you received discount. So here at the time of issuing, bondholders are giving 80 rupees and they are purchasing certificate. They are paying 80 rupees and they are purchasing certificate. But the twist is at the time of maturity, This Aarti Limited will pay rupees 100, and this is how bondholders are gaining. See, ultimately, what is the total amount they are receiving as a bondholder? 100. And what is the invested amount? How much they have paid for purchasing one bond certificate? 80. So you can see here 20 benefit. 20 benefit. And this benefit is known as zero coupon bonds. Zero coupon bonds. Okay? Chal. Then one more we have, that is convertible bonds. Convertible bonds means at the time of issue, you are saying that we are issuing bonds, but after few years, you are going to give right to convert it into equity. At the time of issue, you are saying we are issuing bonds. Now, after 2 years, bond holders can convert it into equity. That is what conversion. Okay, this is conversion bonds. Here you are giving option to bondholders to exchange a bond with number of shares of the issuer's common stock. Common stock means here your equity. Means now, if your bondholders are ready to purchase this convertible bonds and they are ready to acquire equity, so now they will hold ownership. Okay, they will not receive any interest. So this is your one more type. Then let's do this part, that is valuation of bonds. Valuation of bonds means what is the true value of that bond? What is the true value of bond? Because when we are investing, what we are going to see, we are going to observe whether we are paying good amount, overpriced or underpriced. Okay, suppose if I am saying, for example, I want to sell this pen. Okay, I want to sell this pen, and I am saying I'm selling this pen and I'm ready to sell this pen for rupees 15,000. Suppose this is just normal pen. Okay, and I'm saying I can sell this pen for rupees 15,000. What you will think? Or let's increase the amount. Okay, suppose I'm saying I'm going to sell this pen for 1,50,000. So are you interested to purchase this pen? The answer is no, because you know it. This amount is over. This is overly priced. So you will reject it. But if I'm saying I'm going to sell this pen for rupees, suppose 100. So you can say, this is a good amount. You are ready to pay it also. So here you are doing the valuation. Whether the thing is actually that much worthy. If it is, you will pay. You will happily pay for that. But if it is not, you will never going to pay it. You will reject it. Yes. So for valuation, for knowing whether for knowing the value of that thing, whether that is overly priced or underpriced, or that is okay. For that, we need to do some valuations. So here we have valuation of bonds. So how you can value? You can value the bonds with the help of two things. So in bonds, you receive two things. That is your interest plus principal amount at the time of maturity. In bonds, we receive two things. Interest and principal amount at the time of maturity. So with the help of these two things, we will value the true value of the bond. Okay. Now how to use this formula, I will tell you. Chali, so let's start this. A bond with a face value 1,000 carries a coupon rate of 10% per annum payable annually. What will be the annual interest payment? Here you need to calculate just interest payment. This one is the simple one. Chali, so everyone tell me your answer. Bond face value 1,000. Okay, coupon rate equal to 10% per annum. So what is the annual interest payment? Very simple. 1,000 into 10%. That is your rupees 100. This is your answer. Okay, this is how we calculate interest payment. Yes or no? Chali. Now let's calculate the value of the bond. Now I hope everyone understood it, how to calculate the interest. Okay. 5-year bond has a face value 1,000 and pays 8% annual interest. If the market value of interest rate is 10%, what will be the bonds approximate price, means what will be the true value of the bond. Okay, so let's start this solution. Now, for this 5-year bonds, for this 5-year bond, what is the face value? 1000. And what is the coupon rate? How much we are going to receive interest on this bonds if we purchase? That is 8% per annum. Okay. But as an investor, or if I say as a bond holder, I want 10%. Okay, this is the market rate of interest, or you can say in market, if I invest in other things, I can receive 10%. But for this specific bond, what is the interest rate I am receiving? 8%. So can you tell me the coupon amount now? Just use the previous question formula, 1000 into 8%. So 1000 into 8% is your 80. Yes, and for how many years you will receive? For 5 years. Means for first year also 80, second, third, fourth, fifth. Okay, for 5 years you will receive same 80, 80, 80, 80. Now, for the fifth, or you can say at the end, you will receive your principal amount also. And here you will receive 1000 only. Hana? Here you will receive 1000 only. If nothing mentioned, we are assuming whatever the face value is, the same amount we are going to receive at the end. So at the end, you will receive 1000. This is the interest amount. This is the principal amount. Okay, so this is about your bonds. Now, as an investor, what is the interest rate I want from this bond? That is 10%. Okay, that is 10%. So this amounts, what I'm just now I have calculated, this belongs to future. Okay, today is my 0 time period, and this amounts that 80, first, second, third, fourth, and fifth. This 80, 80, 80, 80, and 1000. This amounts are from future. Okay. I have not purchased this bond yet. I am just valuing whether to purchase it or not. Okay, so this is the amount I have calculated that I will earn if I purchase it. But I want to know today's value. But whatever amount I'm paying today, that is worthy or not. So what I will do, I will calculate the future values amount. Present value, today's value. Yes, I will calculate the future incomes to value in my today's value. Okay, for this valuation, for this conversion, I am going to use time value of money, and I will use present value. Okay, I will use this present value. So here, luckily, in question they are giving, use present value for rupee 1 for 5 years. Okay, means for 1 to 5 years, whatever income you are receiving, Okay, so this is just the hint they are given. Suppose if you receive 1 for 5 for 1 years, for 1 year, second year, third year, fourth year, fifth year, or if you earn 80 rupees for 5 years, use this 3.791. Okay, this is the present value, and present value I will calculate with the market value, that is 10%. And here they have mentioned it. So how to calculate the true value? Just use 80, your interest amount, multiply with the present value of 10% for 5 years, add redemption amount, maturity amount, multiply with the present value of 10% at the end of 5th year. Okay, so just take 80 yearly income, multiply with the present value factor, that is 3.791 plus 1000 into at 10% for 5 years, that is 0.621. Just multiply this and tell me the final answer now, everyone. 80 into 3.791, that is 303.28 plus 1000 into 0.621, that is 621 plus 303.28. So correct answer is 924.28. Answer. The true value is only 924 and you are paying 1000, means you are paying extra. Hana, you are paying extra. So this bond is overly priced. You will never purchase it. So this is how you need to calculate bonds value. Okay, chaliye. Let's solve one more question based on this unit only. So which of the following is a characteristic of zero coupon bond? They provide regular interest payment. No. Zero interest. Correct. They are issued at face value. No. They do not pay periodic interest but are redeemed at face value. Yes. They issue at discount and at the time of maturity they are paying face value. So correct answer is your answer C. Then next. What is the key characteristic of equity financing? It creates legal obligation to repay with interest. Then it increases the company's debt burden. It involves giving up ownership and control. It has a fixed maturity date. Equity means when you are sharing ownership. Okay? So when you are sharing ownership, you will never receive any interest. This will never create burden as a equity, as a debt, as a loan. Yes, it has no fixed maturity date. Correct answer is it gives ownership and control in that company. So correct answer is your answer C. In case of liquidation, who gets paid first? Equity shareholder, preference shareholder, debenture holders and creditors, promoters of the company. See, suppose if I started my business, now I am not able to continue my business. What I will do, the first thing, I will pay to my creditors. Yes, I will pay first to bank loan, correct? Before retaining my own amount, before giving to my preference shareholders or to my promoters, firstly, I will pay to the outside parties, to the third parties, okay? Like debenture holders, creditors, banks. So who will get first at the time of liquidation? Debenture holders and creditors. So first thing that we need to understand, that is foreign exchange. Yes, so if we see the definition says foreign exchange refers to exchanging the currency of one country for another at prevailing exchange rates. Here we are converting from one currency to next currency. Yes, that is what foreign exchange. Chaliye, so let's take one example. So here you can see we have here America and one side we have our India. Correct. Now, what we are doing? We are purchasing. Yes, we are purchasing goods. We are purchasing goods. Correct. From America, and we are going to import. If we are purchasing from outside, this is your import. This is your import. I hope you know what is import and export. See, when you are purchasing from outside within India, this is import. On the other hand, if you are selling from India, okay, if you sell from India, then that is your export. Okay. We have these two terms, import and export. When you purchase from outside, that is import. When you sell outside, that is export. Now, in India, we are using which currency? Can you tell me which currency we are using in India? We are using INR. Yes, Indian rupees we are using. On the other hand, in America, they are using dollars. Yes, they are using dollars. Now, seller is from your America and buyer is from India. Yes, buyer earns in Indian rupees and seller, whatever business they are doing in dollars, in their own currency. Now, as a buyer, when we are purchasing from outside, yes, when we are purchasing from outside, we can we pay this INR to that seller? What do you think? That seller will accept INR? No. Why he will accept INR? Because in that country, there is no use of that INR. Yes, there is no value of that INR. So here, as a buyer, we need to convert this INR into dollars. And then only we will make the payment. Then only we will make the payment. Yes, so for making the payment in different currency, we require to convert our domestic currency into any foreign currency. This is your home currency, this is your domestic currency. Now when you are converting into different currency, that is at that time you require foreign exchange rate. Yes, so that foreign exchange rate is required for converting from one currency to our other currencies. This is what foreign exchange means. I hope you got this. So again, let's read the definition. Foreign exchange refers to exchanging the currency of one country. Here we converted INR for another at prevailing exchange rate. For another means here we converted into dollars. Yes, we converted INR into dollars at prevailing exchange rates. Okay, so this is your foreign exchange means. And we have seen one example based on this. Now, coming to one more thing related to it, which is very useful when you are dealing in foreign exchange, that is rate. Correct. First, we understood what this foreign exchange means. Now, next important thing that we need to understand, that is rate. Yes, that is your rate. Now, while reading newspaper, while while you are seeing any news channel, yes, there you might have seen this type of one statement, that is $1 equal to 87 rupees. Yes, or if you see today's rate for one United States dollar equals to 87.47 Indian rupees. Now this means what? Means if I want to purchase $1, I need to pay 87.47 Indian rupees. And every day this rate is changing based on market. Yes, so this changes based on demand and supply. So whenever you want to convert your Indian rupees into dollars, so how much and what rate we need to follow? That is your exchange rate. Yes, suppose I am saying I require $2. Suppose here if I say I want $2, can you tell me if $1 is equal to rupees 87.47? Okay, this is for your $1. So for $2, how much we are going to pay? Tell me, for $2, how much we are going to pay? Just multiply 87.47 into 2. That is rupees 174.94. Yes, so if I want to purchase $2, I require to pay 174.94. Or if I want $10 and $1 rate is 87.47. So I need to pay, or I require Indian rupees, that is 874.70. Yes, this much I required for purchasing $10. So whenever you are doing any transaction outside your domestic boundaries, at that time we require some different currencies. Even if you want to travel Dubai, if you want to travel Malaysia, if you want to travel America, yes, you cannot use Indian dollars there. You need to convert it first, and whatever that currency, that countries they are using, we are going to convert in that particular currency. Yes, for that we require foreign exchange. So what two things we have understood till now? What is the meaning of foreign exchange and what is the meaning of this foreign exchange rate? Okay, I hope now you can read what this means. Yes, so for alternatively you can say we may pay 75, or sorry, this is your 87. This is your rupees 87 to buy $1. Okay, so this is your exchange rate. Now we have quotes under this foreign exchange rate. Sometimes we are going to see direct and sometimes indirect. Yes, but what is this direct and indirect? If you have understood the foreign exchange rate, Then second thing we need to understand, that is direct and indirect quotes. Yes, first we have understood what is the meaning, then rate, yes, how to read that rate, and next thing we are going to talk about the quote. Chaliye. So let's start with this. So foreign exchange quotation can be either a direct quotation or an indirect quotation, depending upon the home currency of the person concerned. Yes, so generally what we see, $1 equal to rupees 75 means what? We may pay 75 to buy $1. है ना? $1 equal to 75 means what? For purchasing $1 we need to pay 75 rupees. Correct? So this is your direct quote. When you can see $1 equal to 75, this is your direct quote. Means is the home currency price of 1 unit of the foreign exchange currency. So direct quote means when you are using foreign currency 1 unit. When you are using foreign currency 1 unit, and based on that we are talking about our home currency, then that is direct quote. We all are in India. Yes. So if we are writing like 1 pounds, rupees 102. So this is your direct quote. Means we are talking as per foreign currency 1 unit. Okay? Based on the foreign currency 1 unit, we are talking about our own or domestic currency amount. That is your direct quote. That is your direct quote. Now, next is your indirect quote. Indirect quote is your reverse of your direct quote. Okay? So here when you are representing foreign currency price of 1 unit of the home currency. For Indians, home currency is your INR. Okay? Home currency is your INR. And apart from INR, all other currencies are foreign currency. Yes. So in direct quote, we are representing by taking 1 unit of foreign currency. But as per indirect quote, we are taking 1 unit of home currency. Means rupees 1 equal to dollars 0.0133. This is your indirect quote. Correct? Direct quote when you are representing in your foreign exchange, foreign currency 1 unit. Indirect quote means when you are representing 1 unit of your domestic currency or home currency. So this is about direct quote and indirect quote, and this is very important. In exam they can ask you direct question based on this. Yes. Then how to convert? What if they are giving you indirect quote and they are asking you about the direct quote, or if they are giving you direct quote and in exam they are asking about the indirect quote. So we can use this formula. We can use this formula. If they are asking for direct quote, use 1 divided by indirect quote. If they are asking about indirect quote, just do the vice versa of this formula. Correct? Chaliye. So let's start and solve 2 questions based on this topic. Okay. So if direct quote of $1 is equal to rupees 45, how can this exchange rate be presented under indirect quote? We need to convert this direct to indirect. Okay. So your direct quote is what? When you are representing 1 unit of foreign currency. So here $1 equal to rupees 45. Okay. Now indirect quote means when you are representing 1 unit of your home currency or of your domestic currency. So here you will do 1 divided by indirect quote, that is your 1 divided by 45. So please calculate and tell me what is the amount here. 1 divided by 45. So this is your dollars 0.0222. Okay. So here your indirect quote is equal to 1 rupee equal to $0.022 and 2. Always remember when you are reading foreign exchange, after decimal, we are going to take 4 digits. Always remember when you are reading your forex, always take after decimal 4 digits. Okay, this is the assumption you need to take while solving a foreign exchange. Chali, so this is about your direct quote if you are converting into indirect quote. Coming to the next question. Everyone please try once. Let's see how many of you can solve this. So if indirect quote is $0.025 per rupees, how can this exchange rate be shown under direct quote? So here we need to calculate. Okay, so here we have indirect quote. And that is US dollar per rupees. So 1 rupees equal to $0.025. Yes, this is your indirect quote. So how you can get this into a direct quote? Please everyone try to solve it. So now we need to convert indirect quote into direct quote. Okay, we need to convert it into direct quote. So what you will do, 1 divided by your indirect quote, or you can say your dollars. So here 1 divided by 0.025. 1 divided by 0.025. So here your $1 is equal to rupees 40. And this is your answer. Okay, you need to just replace the amounts. So this is as per your direct quote and this is as per your indirect quote. Okay, this is as per your indirect quote. So here you need to write that is your direct quote. Yes, and here is your indirect quote. So this is how you need to solve in your exams also. And remember, this type of questions they are going to ask for conversion. Correct? Chali. So this is about direct and indirect quote. Now coming to important topic, that is again bid and ask. Now this is very important while getting your foreign exchange rate. Sometimes they are giving bid and ask also. But what is this? See, you must have seen this type of exchange rates. Yes. Or you must have seen like $1 equal to rupees. Suppose 85.76, 85.79. Yes, you must have seen this type of exchange rates. Correct? Like $1 equal to rupees 85.76 slash 85.79. So which rate we need to use and when to use which particular rate, and this rates are actually what? Yes. So remember one thing, this right side rate is your ask rate. This is your ask price. On the other hand, this 85.76 is your bid price. This is your bid price. Now, as a customer, whenever we are purchasing, whenever if you are purchasing any goods, you are purchasing at a high cost. Okay, you are paying more amount. But when you are selling the same goods, you are getting lesser amount. Okay, means what? See, suppose I am a shopkeeper. Okay, you want this calculator. I am saying I will give this calculator for 500 rupees. So you will pay me 500 rupees. Now after 1 month, you are saying, no, we don't want to use this calculator. Please purchase it back. So I will not purchase this calculator for 500 rupees. I will purchase this for 450 or 400. Yes. So always remember, as a customer, you are purchasing at a higher amount and you are getting lower amount. Suppose if you are purchasing jewelries, so you will purchase jewelries for a higher amount. But if you return the same jewelry after 1 day, 2 days also, you are going to receive lesser amount. Okay. So what we are doing with this particular foreign exchange then? How we are linking this thing? See, here, suppose if you want to purchase this $1 as a customer, if you want to travel, ठीक है, and for that traveling you require $1. So for purchasing $1, you will pay which amount? Higher amount, है ना? You will pay higher amount. So this is your ask price. ठीक है, this is your ask price. Now after completing your travel, if you are coming again in India from abroad and you want to convert your dollars into Indian rupees, because that dollars is of no use in India. Yes, so you want to convert it into Indian rupees. So which rate you will use? At the time of purchasing that $1, you paid more amount. But after 1 month, if you are returning the same dollars, you will get lesser amount, and that is a bid price. That is a bid price. Okay, let's read the theory given here. So bid indicates the demand, while ask indicates the supply of a stock when you are purchasing. So here bid means, bid is a maximum price that a buyer is ready to pay for a specific product. Bid range is usually higher than the current market price. Bid rate is always lower than the ask rate. See, bid rate is always lower than the ask rate. Yes, then ask is the maximum price that the seller is asking for a product. If you want to purchase $1, what is the maximum price you need to pay here? And ask price is always more than your bid price. Ask price will be lower than the current market price. Okay, so this is about bid and ask. Always remember your right side, yes, after slash, that is your ask price, and that side is always going to be higher amount. On the other hand, if you see your left side, that is going to be at a lower side, and that is your bid price. Okay, always how you can remember this? See, while reading alphabets, how we read? A, B, C, D, E. Yes, this is how we read alphabets. But in case of Forex, you start with B and A. Okay? Under the Forex, you are not reading A, B, C, D, E. No, you are reading in a reverse manner. B, A. B, A. Okay? Always in Forex, we are going to read in a reverse manner. B, A. First B will come and then A will come. Correct? Bid and ask. Chali, I hope you can use this trick for remembering this formula. So let's solve questions based on this. A bank quotes USD INR as 83.20 / 83.60. What does 83.20 represent? They are asking about this. Here, ask rate, forward rate, bid rate or spot rate. So just now we have seen what is ask rate and bid rate. So there is no relevance related to forward rate or spot rate. Okay, so tell me, what this 83.20 represents? I told you that trick now. We read alphabets in a reverse order, B, A. So this is your bid and this is your ask. Correct? So correct answer is answer C. Coming to the next one. In Forex, the difference between the ask rate and bid rate is called spread, margin, premium, discount. See, if I talk about bank receives, bank deposits, yes, bank takes deposits and bank gives loans, yes. So here, whatever bank they are paying on deposit, that is, suppose 6%, and whatever amount they are getting from loans, that is around 14%. Interest from loan is going to be higher than whatever they are paying on deposit. And the difference, and the 14 minus 6, that is your 8%. That difference is what for bank? This difference is going to be income for bank. Yes, the same thing under spread when they are getting the difference. They are getting the difference from the bid and ask. When they are subtracting bid and ask, the difference is known as spread. Okay, that difference is known as spread, not margin, premium or discount. Correct answer is your answer A. Okay, now let's see the next topic in a very quick manner. So next is your value date. Now we have different types of value dates. So I will explain this one with the help of this chart. Okay, so basically we have 4 concepts. First, cash ready. Second, term, C, spot, and D, forward rate. Cash or ready means if your transaction you are doing on 24th April 24 and you are making a deal on the same date, if you are entering transaction on the same date of that transaction, you are making a deal on that same date only, then that is known as cash or ready. That is known as cash, or you can say ready. But if you are dealing in a transaction on 24th April, but the deal you are getting into that is on 25th, means next day. Yes, tomorrow. So that is term. Tomorrow you are going to enter in that deal. That is term. So that is B1. Spot means after tomorrow. Okay, day after tomorrow when you are entering into a transaction, means your date of transaction is same 24th April, but you are going or making a deal on 26th, then that is your spot rate. That is your spot. And after 26th, okay, after this 26th, if you are entering into deal, then that is forward rate. Cash and ready, same day. Term means tomorrow. Okay, after a day after tomorrow, that is spot. And day after tomorrow, after spot, or you can say you are going to use forward rate. See, okay, so these are the 4 important terms under this forex. Now, we need to understand that as a business, when we are going to use this thing, yes, capital means your funds. Yes, understand one thing here, capital means your funds. So, what structure we want to create for our funds? Yes, now if I say that if we are starting any funds, correct? So, you require money for what? You require money to purchase all this long-term assets, yes, like non-current assets, like building, machinery, yes, plant, equipments. You will purchase all these things to use for long term, yes, to use for more than 12 months. On the other hand, whatever business you are starting, so for that you are purchasing raw materials, finished goods you are preparing, and you are selling to your customers. Along with that, we have cash. So all these things are your current assets. But for doing this operational activities, yes, like manufacturing, selling, yes, or purchasing your long-term assets, we require funds. We require funds. Without funds, you cannot purchase, you cannot manage your business. Yes, so ultimate thing for our business is what? That is your funds. Now, how you can arrange this funds? Suppose if I'm starting my business, so first thing what I will do, I will see how much money I have. Okay, first I will use my own saving. Yes, I will use my own saving. Then afterwards, I will ask to my family members if they contribute in my business or not. After that, what I will think, I can take a bank loan also. Yes, I can take bank loan. I can ask to my friends also. Yes, so all are the ways through which I can arrange the funds. Yes, but there is 2 things in our business as a funds that we need to understand. Your fund which your owner is giving to your business, or that is loan part. Okay, so majority of the times your funds are divided into these 2 parts. Yes, so funds are divided into these 2 parts. That is your owner fund or loan amount. These are the 2 ways. Okay, when I'm using my own source, that is my owner's fund. Yes, or if I'm sharing my company's ownership or whatever members are contributing to get that membership, that is also they are going to be known as owners. So one is your owner's fund and one is your loan amount. Okay, loan amount means when I'm borrowing from my friends, family, or if I'm borrowing from any particular bank or this NBFCs or any party. Okay, so that is loan amount. So we call this owner fund as your equity. Means when you share ownership, that time we call it as equity. On the other hand, when we're talking about loan, means when we're talking about debt. Yes, so whatever borrowings you have done, that is your debt amount. So funds are going to be part of 2 things, equity and debt. Okay, equity is when you are sharing ownership, debt when you are borrowing from someone. So this is how you can arrange funds for your business. Yes, now in this we need to understand Capital means what? Capital means funds. Yes, and how you can arrange these funds? Just now we have seen two sources. Source number one, you can use your own funds, that is your equity, or you can borrow, that is your debt. Yes, you can borrow, you can do the borrowing, that is your debt. So here funds are of two types, equity and debt. Okay, but in what amount we are going to bring, your debt amount or equity amount, that we need to understand. So what is this capital structure? See, let me give you one example here. Suppose here is your Reliance company and here is your XYZ company. Okay, now in Reliance company they are saying the equity portion, okay, total is your 100% always. Now in this Reliance company, equity portion means Ambani's, they are the owners, yes, they are the founders, so they have contributed in this Reliance industry, suppose 70%, and debt they have taken, that is 30%. Debt means borrowing, okay, they have done only 30%. On the other hand, if I talk about XYZ company, in this company the equity is only 40% and debt from different sources they have taken 60%. Yes, means what? Suppose a total fund they both the company requires, that is suppose 10 lakhs. Okay, both company wants 10 lakhs. So how Reliance company arranged this? 7 lakhs Ambani's invested and 3 lakhs they have borrowed. On the other hand, if I talk about this for XYZ business, so owners contributed only 4 lakhs and they have borrowed 6 lakhs from outside. That is debt amount. Now, after seeing these two companies, Reliance and XYZ company, now my question is, which company is going to be in a higher risk? If I ask you to invest, okay, in which company you will never going to invest? Tell me, Reliance or XYZ? See, I know Reliance is a famous company. We know their past, but we don't know about the XYZ. I'm not asking from that point of view. I'm asking based on this investment. Ambani's are investing 70% and debt they are taking 30%. On the other hand, XYZ. Achha, leave XYZ. Let's take Tata. Okay, now you know Tata company. Okay, now you know both companies past. But now I'm asking, in which company you are going to invest? Just think and tell me the answer based on this equity and debt. As a banker, to whom you will sanction loan first? If both are in a equal net worth, yes, both are doing the same work, then which company you are going to issue first loan? Of course, they Reliance, because risk is less. Now, why risk is less? Because the majority of the amount is invested by their owners. Yes, so here the risk is less compared to your company, Tata. Yes, so the chances of investment is going to be with Reliance industry. So this structure, you know, this debt and equity, this is the structure. Structure is what? Owner, or you can say equity contribution is 70%, debt is equal to 30%. This is the structure. This is structure of Reliance industry. Okay, and now can you tell me what is the structure of XYZ company? The structure is owner's fund is 40% and debt is 60%. This is the structure. Okay, that in a company, how much we have borrowed and how much we have invested as a owner. So this is what structure is. Correct? So the long-term money required by the firm is known as the capital. Okay, the funds. Capital structure referred to as the proportion of debt equity in the total long-term funds raised by the firm. If I talk about Reliance industry, if I talk about Reliance business, so how much they have raised to the debt, that is 30%, and how much to the equity, that is 70%. Okay, that is 70%. So here the long-term money can be from two sources. Just now we have seen, again we are repeating, from equity, money of the owners, or debt. Debt is what? That is borrowing. Okay, so this is about your capital structure and that meaning. Now let's solve an illustration based on this. A firm starts its business by raising total long-term fund 500 lakh to meet its requirement, equity capital 200 lakh, debt capital 300 lakh. So here we want to start in business, and what we have decided, the total fund we want 500. Yes, this is the total fund we want. Now how I will arrange this fund? I will take the owner's amount, that is equal to 200, and I will take debt amount, that is equal to 300. Yes, and if I add this, this is my total fund. Now here, if I want to know the proportion, if I want to know the proportion of each funds, yes, if I want to know the proportion of funds, how I will do it? I will take, suppose, first equity. So I will take equity amount divided by 500. Yes, equity portion divided by total fund into 100. So can you tell me the answer? What is the proportion of equity here? 200 divided by 500 into 100. So this is your 40%. This is your 40%. Now can you tell me what is the proportion of debt? Again, do the same thing, 300 divided by 500 into 100. So that is 300 divided by 500 into 100. This is a 60%. Yes, so this is how we calculate proportion. Okay, this is how we calculate proportion. Or you can also go with this if you want to know about, suppose, equity. Okay, equity proportion. You can subtract 1 minus D. Suppose let's take, only 1 is your total. Okay, 1 means this is your total. So 1 minus, what is your percentage? You can write 60% or 0.60. Yes, you can write 100 minus D percentage or 1 minus 0.60. So this is 0.40 or this is your 40% if I represent in percentage. So this is how I can also calculate equity proportion. Same, I can calculate debt proportion. 1 minus equity. So 1 minus, if I see equity side only, 0.40. So your equity is, debt is 0.60. Or you can say this is your 60%. Yes, this is your answer. In case they're asking debt proportion, I'm giving only equity side, and if they're asking equity proportion, only giving debt amount. Okay? And if they're asking proportion for both the things, then you need to use this left side calculation. Okay, chali. So here we have understood about the capital structure and how to calculate the proportion based on that structure. Now, we have one more small topic, that is leverage, gearing. So in the capital structure of a firm, if the ratio of the debt capital is high, it's called highly leveraged or high geared firm. Means what? If you're taking more borrowing amount than your equity amount, then your firm is known as high leveraged geared firm. On the other hand, if the ratio of the debt capital is low, it is called a low leveraged or low geared firm. Okay, so this is what about leverage. If you're borrowing more, then you are going to be known as high leverage firm. Acha, let's solve one question here. Let's see how many of you understood this part. Again, I am taking the same example. This is your Reliance and this is your Tata. Okay, why I'm taking again and again the same example? Because in exam they can ask questions based on analytical perspective also. Okay, so that's why we need to understand what the concept is, practically also as well as theoretically also. So just now we have covered your theory part. Now let's apply it. So if I say this is your equity, now you know what is equity, yes? And if this is your debt, you know what is debt? Debt is your borrowing amount. Equity is what? Equity is your owner's amount. So suppose in your Reliance Industry, equity is your 80% and debt is your 20%. Okay, on the other hand, if I'm tell you about Tata, equity is around 70, under Tata, that is around 35% and debt is around remaining, that is 65%. So now my question is, which is going to have high leveraged or geared firm? Tell me. Reliance or Tata? High leveraged or highly geared firm means in which you have high borrowing amount. है ना? High debt capital means high borrowing amount. So which company is having high borrowing amount? Reliance or Tata? Correct answer is your Tata. Okay, so Tata is known as highly leveraged firm, whereas Reliance is known as low leveraged firm. Correct? So this is one small topic based on your leverage and gear. Now, we have one more small topic. These are, very important from exam perspective. That's why I'm completing, yes, subtopics. Now, coming to the next important topic, that is weighted average cost of capital, known as WACC. Yes. So here, just now we have understood the meaning of capital. Capital means your funds. Okay. How you can arrange this funds, equity plus debt. Okay. Now for arranging these funds, I need to incur some cost. Yes. Like for issuing equity. Yes. I need to pay dividend on that. I need to incur issuance cost. Yes. So all this is what cost for a company. Cost for company. Whereas if I am taking a debt, I need to pay some fees. Yes. Processing fees. All these things. All these things are again what cost for a company for taking a loan, for taking a debt. So if I want to know what is the total cost I incurred for taking funds, if I want to know what is the total cost I need to incur for taking total funds, then I am going to use this topic, that is WACC. But can I just go and directly add it? The answer is no. You cannot take direct addition. For this particular purpose, for knowing the cost of capital, we need to go with the average. We need to take weighted average. We need to give weights and then we are going to calculate. Okay, so WACC is what used to determine the cost of each part of the company's capital structure. And generally we have seen just now proportion of equity and debt. Okay. Now, it represents the rate of return that a company must pay for all of its financial sources such as debt and equity. So, your formula that you need to use for calculating WACC is proportion of debt. Just now you have seen proportion of debt. Yes, you will calculate in percentage. And if tax rate is given, if tax rate is given, subtract 1 minus T. If not, then ignore. Okay, then just ignore it. And cost of debt, again they are going to give you in your question if they're asking WACC. Otherwise, again we are going to learn how to calculate cost of debt in this unit only, but not in today's session. You need to add, okay, after giving the weighted weights, you will add to the cost of equity into proportion of equity. Proportion of equity, just now you understood how to calculate this proportion of equity. Okay. So here you will take that proportion in percentage and the cost of equity. Again, they are going to give you in questions. Otherwise, we have again 4 to 5 formulas for calculating cost of equity. Again, I am not covering that part in today's session. Chali. So let's start and use this formula. A company has the following capital structure. If equity is 60 lakhs, cost of equity is 12%, debt 40 lakhs, cost of debt 10%, tax rate is 30%. Now, first, let me write you the formula. Cost of debt into proportion of debt plus cost of equity into proportion of equity. Okay. So let's calculate first about the proportion. How to calculate proportion? How to calculate proportion? First step is calculate total funds. What is your total fund? Add your equity plus debt amount. So 60 plus 40. So this is going to be your 1, 2, 3, 0, 0, 0 and 0, 1. Yes, this is your total. 1 crore is your total funds. Now, second thing, let's calculate the proportion of equity. So 60 lakhs divided by 1 crore into 100. 60 lakhs divided by 1 crore into 100. That is a 60%. Yes. And for the third, that is proportion of debt. 40 lakhs divided by 1 crore equal to 40%. Now let's put the figure, because already we know the cost of debt, that is 10% into proportion of debt, how much? That is 40%. But remember here tax rate is given, so 1 minus 0.30 plus cost of equity, that is 12% into your proportion of equity, that is 60%. So if you solve the first bracket, 0.7 into 0.4, yes, just wait. So solve the bracket first. 0.7 into 40% into 10%, then 60% into 12%. So your total WACC is going to be 7.48%. Please everyone cross check it. Hana? Once this up to this point we are correct. Just cross check the answer once. Okay. So this is your WACC, and this is how we need to calculate. Okay. Now one question is homework for you. Just remember here we have the preference shares. This is one of the again way through which you can borrow the amount. Okay. So this is your homework question. Just I'm giving you the formula. You just need to put the amounts. Cost of debt into proportion of debt plus cost of preference shares into proportion of preference shares plus cost of equity into proportion of equity. Okay, use the same way for calculating the proportions. Okay, just remember you have one extra thing, so you need to add that part. So total funds here you are going to take, that is 20 lakhs plus 10 lakhs plus 30 lakhs. Yes, so 50, 60 lakhs. Now I hope you can calculate, and this is your homework question. Everyone try this and share your answer through the comments. Okay, now one more thing, that see, decision means what? When you need to select any one alternative. Yes, like after clearing 10th standard, you got the option to go with the science stream, to go with the commerce stream, to go with the art stream. Yes, so you opted suppose science stream. So that is the decision you have made. Correct? So this is the meaning of decision. But in your AFM, we are talking about investment decision. Means what? Suppose if I am holding rupees 1 lakh. Now with this 1 lakh, whether should I purchase jewelry? Yes, or should I purchase some shares, or invest in FD, or go with the mutual funds? Now I will evaluate different options where I can invest this 1 lakhs. Yes, and when I'm evaluating what things I'm going to search, I will search what returns I will receive. Yes, what returns I will receive, and which of the options are, less risky as well. Options which are having less risk. So suppose if I'm saying if you go with the jewelry, the risk is suppose 10% and the return is just 5%. Shares, I can say you are going to receive suppose 16% return, but risk is suppose 20%. With the FD, you are earning suppose just 7%. On the other hand, there is zero risk. Mutual funds, you are going to receive this return, suppose 15%, but risk is suppose 7%. Yes, I have evaluated this different options. Now, after analyzing each options, I can say mutual funds is your best option. Hana, in this you are receiving good return as well as minimum risk we have. So what as an investor we will do? See, FDs, that 7% is very minimum amount. The inflation rate is around 6 point something. Yes, so I'm not going to earn anything. Whatever I'm earning, that is equal to inflation price. Yes, so what I will say, FD is okay, but if I go with the mutual funds, I am earning a good amount of return. Even I have to I have to face some risk, but that is very minimum compared to remaining options. So when I'm going with the mutual funds, then let's invest my 1 lakh rupees in this mutual funds, then that is the investment decision I have made. Yes, this is the investment decision I have made. So what is investment decision? It refers to selecting the best options by evaluating and analyzing for the business. Like from this options, I have selected mutual funds. Correct? This is the best option by evaluating, by analyzing return as well as understanding the risk. By analyzing these things, I have evaluated and analyzed for the business. Correct? Same concept as an individual, what we are doing, what we are calculating, the same thing businesses are doing. Okay, so this is what investment decision. Now let's talk about from the business point of view. Suppose here is a company and the company wants to invest rupees 10 crores. Now what they will do, they will identify the projects. What are the projects? What are the options they have? Suppose in your first project, they want to manufacture car electronic vehicle. Yes, they can start this electronic vehicle manufacturing. Now in your second project, they evaluated that they can start this solar panels. Okay, so these are the two options which this company identified. Now, in both the companies, if they talk about the investment amount is 10 crores only. If they go with the project A, 10 crores they will invest. If they go with the project B, they will invest 10 crores. Now, what they will do? They will identify the return. What they will search, the next thing, they will start analyzing, evaluating. So, the first thing they will talk about the return. If they start this electronic vehicle, what return they can earn? Here, they can earn, suppose, 45%. This is the return amount. If they go with the solar panels, they can earn, suppose here, 27%. Okay. Now, next thing they will talk about, that is risk. So here, suppose risk, if they go with the electronic manufacturing of the cars, their risk is suppose 9%. And if they go with the solar panels, their risk is suppose 13%. So this is the analysis they are going to do. Now, after understanding that, okay, if they go with the car electronic vehicle, their return is high as well as risk is low. Return is high, risk is low. But if they are going with the project B, that solar panels, their risk is 13% and their return is also 20%. So as a rational investor or as a management, what I'm going to select? Of course, project A. So when I'm going with the project A, that is what decision I have made. Yes, what future return I am going to earn, what risk I am going to face. So if I am calculating through this kind of, analysis, evaluations, then that is what investment decision. So this is your investment decision. Correct? I hope everyone understood what is the concept, what is the meaning of investment decision. Now, after that, let's talk about the methods. Okay, we have methods of investment appraisal. For calculating this investment decision, for making that investment decisions, we have major two sides. First one, when you can use non-discounted methods. Next side, discounted methods. If you divide the major part of this investment decision, you have two sides. First, non-discounted methods. Next, discounted methods. Now, what is this discounted methods? Leave for some time. Yes, let's talk about non-discounted methods. Under this, you have two methods. Number one, that is your payback period. Second one is your accounting rate of return, ARR. payback period method and accounting rate of return. These are the two methods covered under non-discounted methods. So let's start with the first one, that is payback period. Payback period is a very simple method. Now, as per this method, if I take with example only, okay, so let's start with one example. Suppose today I purchase one car for 5 lakhs. I purchase one car for 5 lakhs and now I'm going to use this car for rental purpose. And every year I'm going to generate from this car, suppose 2 lakhs. Not 2 lakhs. For a time being, let's say every year I'm going to generate 1 lakhs. From rental, I can generate yearly per year 1 lakh as my rental income. Again, I am repeating this example. If I purchase one car by investing 5 lakhs and after purchasing, I am going to use this car for rental purpose. So I will earn the rental income, that is 1 lakh per year. So my question is that if you earn 1 lakh per year, in how many years you can recover this 5 lakhs? Tell me. In how many years you can recover your invested amount? Okay, so let's see. 1, 2, 3, 4, 5. Okay, so first year also 1 lakh I'm going to earn, second year also 1 lakh, third year also 1 lakh, fourth year also 1 lakh, fifth year also 1 lakh. Means I will get this 5 lakh return after 5 years. Hai 1 lakh, 1 lakh, 1 lakh, 1 lakh means within my 5 years, I will recover my invested amount. And this is what your payback period means. Payback means whatever you have invested, in how many years you will get it back. Yes, that is what payback. And what is the time period? That is 5 years. So what is the payback period here? Within how many years you can recover your invested amount? That is your payback period method. Now let's read this. So payback period is the period at the end of which the initial investment is entirely returned to the investor. So as per this example, I am going to recover, yes, as per this example, I am going to return, I will get the payback period as 5 years. Correct? So this is how we are going to calculate. Payback period means the simple calculation, what we are always doing. In how many years we are going to recover it? Just by adding. Yes, whatever the future incomes we are analyzing, we are just going to add it. The same thing payback period talks about. Now, it is to be remembered that both the positive or negative cash flows are to be added till the total net cash flow equals the amount of the initial investment. So what is the formula here? Payback period method equal to amount to be initially invested divided by estimated annual net cash inflow per year. So here if I use this formula, amount to be initially invested, that is what? 1 lakh or 5 lakhs? What is your investment amount? 5 lakhs. 5 lakhs. Divided by estimated annual net cash flow per year. Every year, what is your annual return? Yes, that is 1 lakh divided by 1 lakh. So here your answer is 5 years. Yes, this is your payback period. And as soon as you calculate this period, you will stop calculating. Yes, this is a very simple method, and if in exam they are asking this type of questions, I know you are going to tackle it. Yes, so let's start with a question. Let's practice. A company plans to invest 8 lakhs in a project. The project is expected to generate a constant annual cash inflow of 2 lakhs. Calculate the payback period. Payback period equal to, here, your initial investment divided by estimated annual cash inflow. Initial investment is your 8 lakhs divided by 2 lakhs. So your answer is 4 years. This is your payback period. I hope everyone got this answer. Okay. These are the two methods which we are going to cover under the discounted methods. But what is the meaning of discounting? Yes, what is the meaning of this discounted here? So first, let's talk about this. What is the meaning of this discounted word? So discounting means this is the discounted cash flow, DCF, is a valuation method. This is a valuation method that estimates the value of an investment using its expected future cash flow. And as an analyst, we are going to use DCF to determine the value of an investment today based on projections of how much money that investment will generate in the future. That is what discounted cash flow. So now if I take one example and if I discuss this discounted cash flow, means if this is a 0 time period, okay, this is your this is your 0th time period, correct? Now at this 0 time period, suppose I am investing rupees 4 lakhs, correct? At this 0 time period, I am investing rupees 4 lakhs. Now this is my first year, this is my second year, third year, fourth year, fifth year, sixth year. Correct. After investing 4 lakhs, yearly, if I check every year, suppose first year, if I am generating now, let's talk about income. Okay. First year, suppose I am generating 70,000. Second year, I am going to generate 90,000. Fourth year, 1 lakh. Second year, 1 lakh 20. Sixth year, I am going to generate 1 lakh 50. Okay. If I am using non-discounted method, means if I am using suppose payback period method, what you will do, you will just add all these cash flows. You will add all these cash flows till you recover your 4 lakhs. This is a normal calculation. As a layman, we always do. Okay, as a layman, we always try to add our future incomes, and by that we always say the answer. But when you are actually working as a financial analyst, or when you are working or when you are reading finances, yes, so here we know one thing, that there is one term known as inflation. There is one term known as inflation, because of which prices are increasing. Correct? The same, if you are purchasing today one Parle G packet, you are paying rupees, the same 10 rupees, but that quantity that has been reduced. Correct? That same Parle G, if you would have purchased in your 2000 money, because of inflation, your prices are increasing day by day. So as a financial analyst, when we are talking about finances, we are always going to adjust all our future incomes based on this time value of money. Based on this, discounting, inflation, we are going to adjust our future incomes. Here you can say 70, 80, 90, 1 lakh, 120, 150. All this incomes, all these are future incomes, and these are not adjusted based on inflation part. So first, what I need to do, I need to convert this. I need to adjust all these future incomes based on inflation. Correct? And for that adjustment of that inflation, I am going to use for this inflation adjustment time value of money. Means whatever money you are receiving today, that is not going to equal after 1 year or tomorrow also. Okay? So here we are going to use this time value of money to adjust this inflation. And for this adjustment, we use discounting. We use here discounting. Correct? Discounting. Means if I want to know what is the value at a 0 time period of all your future incomes, I will do discounting. Okay, so if yes, this is a 0 time period, and if I want to know today's value, yes, at your 0 time period, if I want to know the value, so what I will do, I will value the first year's income and I will discount it. I will bring it back by discounting by 1 year. So what is the formula of this discounting? Discounting formula, or you can say the present value formula. Under this discounting, we have two sides. One is your present value and one is your future value. Okay. So if you want to know after 10 years, after 12 years, the true value, that time you will use future value. But if you want to know the after adjustment of inflation part, what is the today's value at your 0 time period, that time you use this present value. And the formula for this present value is whatever the cash flow you are generating divided by 1 plus r to the power n. 1 plus r to the power n. This is the formula we need to use. So whatever income you are generating in your first year, that is 70,000 divided by 1 plus whatever the rate they are providing, every time they will provide in question. Power 1, because 1 year you are going to bring it back. Okay? Same for the 80,000. 80,000 divided by 1 plus whatever r they are going to give, power 2, because 2 times you are going to bring it back. Yes, for the 4th year, suppose 1 lakh divided by 1 plus r to the power 4, because 4 times you are going to bring back, because we are going to calculate at a 0 time period. Yes, now if I want to calculate for the 6th year, can you tell me? You will divide by 1 plus r power 6, because 1, 2, 3, 4, 5, 6. 6 times you are going to bring it back. So this is how you are going to use the power. And this is your discounted cash flow, correct, for when you are adjusting the inflation part. Now the first thing under this discounted cash flow is your net present value. Net present value. Now net present value means a rupee now is more valuable than the same rupee a year later. Now net present value used in terms of cash flow means the present value of all future cash flows. So basically here when we are talking about NPV, that is saying whatever sum of all future incomes present value minus, yes, sum of all future incomes present value minus your initial amount. Correct, your initial amount. And if here you get more amount for your sum of your future income, you will accept the project. But if you are saying the amount you have invested today, that is more than the amount you are receiving, then you are going to do what? You are going to reject that product. Accept, reject. Accept, reject. Yes, so this is how we need to calculate time value of money. So net present value formula is what? Present value of net cash inflow minus total net investment amount. And if your NPV is more than or equal to 0, accept the project. NPV is less than 0, then reject the project. Now, let's solve one question based on this concept. So compute the NPV for a project with a net initial investment 1 lakh and the net cash flow for year 1 is 55, 80 and third year 15,000. Now what they are saying that we are going with one project. This is a 0 time period, first year, second year and this is a third year. In a 0 time period you are investing 1 lakh rupees. Here this is your invested amount. This is your invested amount. Now in your first year you are going to generate 55,000 as your income. Okay. And in your second year you are going to generate 80,000 as in your income. Third year 15,000 as your income. Now we want NPV. So first what we are going to do, first we are going to calculate all these future values, their present value. Hana, because all these are future incomes and first we need to adjust it by inflation. So how I will adjust this 55,000 to bring it at your 0 time period? 55,000 divided by, now R is your 10%. R is your 10%. So what is the formula? Cash flow divided by 1 plus R to the power N. 55,000 divided by 1.10 to the power 1. Because once only we need to bring it back. Now let's calculate for 80,000. So 80,000 divided by 1.10 to the power 2. For the third year, yes, what is your amount? 15,000. This is a 15,000 divided by 1.10 to the power 3. 3 times we need to bring it back. So let's calculate your present value of future inflows. So for the first year, what you will do? Just type 50,000. How you divide? Suppose if I say divide 10 divided by 2. How you will do this? Just write 10 divided by 2 and you will press equal to button and you will say answer is 5. Correct? Again, if I say divide 25 divided by 5. How you will do with the calculator? Everyone please do with the calculator. How you will do it? 25 divided by 5. Correct? I hope you know how to calculate with your calculator the basic division. Okay. So if you know this one, if you know how to calculate with your calculator, then let's come to this part. Okay. Now let's come to this part. What is the numerator here? That is 55,000. And what is the dividing figure? Denominator 1.10. 55,000 divided by 1.10. Yes, this is what we generally do, divided by 1.10. And when your power is 1, just press once equal to button. Just press once equal to button. Means for the 0 time period, if you bring this 55,000 1 year back, today's value is 50,000 only. Today's value is 50,000 only. You know what is the difference in case of power and in your basic calculation? Only the difference is your power. Yes, only the difference here is your power. Whatever power they are giving, yes, whatever power they are giving, just press for that power calculation equal to button, that is same time whatever the number they are mentioning as a power. Okay, means what? See, 80,000 divided by 1.10. What is your power? 2. So press your equal to button for 2 times. 1, 2. So your value, that is 66,115. Now, for the third one, 15,000 divided by 1.10. Now, what is your power? 3. So, how many times you will press this equal to button? 1, 2, 3. Your answer is 11269. 11269. So, what is the total present value of future cash flows? 55,000 plus 66,115 plus 11269. 127,384. Means today you are investing 1 lakh and by this 1 lakh you are generating 127,384. This is the income amount. So what is your NPV here? 127,384 minus 1 lakh. So your answer is 27,384. This is your answer. And this is how we need to solve your NPV questions. Okay? Now remember one thing, for more questions, for more better understanding, you can join my paid batches.